In 2020, we had a very serious crisis in our country, and our GDP dropped with 6.1%. So what were the main drivers of your decision to not decrease Georgian sovereign credit ranking despite this crisis?
Firstly, good afternoon, Shota, and thanks for having me on. We published our most recent report on Georgia last week on the 26th, and in that we have affirmed the ratings with a negative outlook. So I think the first thing to highlight is that we have revised the outlook downwards, so negative from stable before. Now, there are a few reasons why we affirmed the ratings. Like you said, the Georgian economy did have a very significant contraction of 6% in its real GDP. But of course, Georgia is not the only economy in the world at this point of time facing a pandemic with the stress on its economy. We do take into account that the authorities did have some space to undertake sizable counter-cyclical policy in the face of this very large economic shock. And there was a very sizable fiscal and monetary policy response that cushioned the economy to some extent from the blow of the pandemic. Very importantly, in our ratings consideration, while there was a loss of foreign earnings, particularly from tourism receipts and a fall in FDI, we did not see foreign exchange reserves coming under pressure during the year. Now, this was, of course, possible because of loans from international financial institutions. So even though we saw an economic adjustment, we didn't really see a balance of payments crisis for Georgia. Now, the flip side of this is that while external liquidity was preserved and we didn't see a crisis on the balance of payments front, the economy and the government both are a lot more leveraged now following 2020, particularly in terms of foreign debt. And we think that at the same time, even though there has been an increase in leverage, Georgia's capacity to earn in foreign earnings, foreign exchange over the medium term, at least, has been diminished because of the outlook for both tourism and foreign direct investment. So we affirm the ratings, but taking these factors into account, we did revise the outlook to negative.
Yes, and as S&P has mentioned, Georgian economy has balance of payments vulnerabilities, including economy's import dependency and sizable external liabilities. And in 2021, our debt to GDP ratio has exceeded 60%. So do you see any major risks from increased debt levels? And what would be your recommendations on the state budget? What can be done to lower the deficit?
Mm-hmm. So I think the first thing to say is that, yes, we do see higher risks from Georgia's increased general government debt. So firstly, just in the past year, debt has increased by more than 20 percentage points. And we think that it will rise further to about 70% of GDP in 2021. This is a very substantial increase from the 40% of GDP that government debt stood at in 2019. And in general, from our point of view, higher levels of debt do imply reduced room for fiscal policy maneuver. We also think that other characteristics of debt are quite relevant. We think, for example, that the higher the proportion of debt that is denominated in foreign currency, that is the currency which the government does not necessarily have in its local currency, that increases risks to the debt profile. Now, in Georgia's case, that percentage is fairly large. It is at 80%. And whenever we see a fairly sharp depreciation of the Lira against other currencies like the dollar or the euro, we do tend to see an increase in the debt profile. On your question on what Georgia can do to reduce its debt stock, I'm afraid at S&P we don't really offer policy advice. We are not in a position to offer this to governments, but we do observe that GDP that tends to be the tax base on which governments, or rather the base on which governments tax, usually changes in growth or improvements in the structure of economies provide a more sustainable footing for debt reduction.
And as S&P has mentioned in the report, you suspect slight depreciation of Lira foreign exchange rate, and one US dollar would be 3.5 at the end of the year. Also, you suspect depreciation in medium-term future. What is the reasoning for this projection, and do you think that NBG should provide additional FX interventions on the market?
So since we don't offer policy advice, I cannot really say what the NBG should do. What we have seen the NBG doing, of course, is it has an inflation targeting mandate, and whenever it sees a risk to its inflation target on a forward-looking basis, it tends to intervene if a depreciation is threatening the pass-through of imported inflation into the domestic inflation print. So I think that probably is going to remain a feature in Georgia. But then again, at the same time, it depends on the level of FX reserves that the central bank also has. So in previous years, in the last few years, before the pandemic, we did see the National Bank of Georgia actually proactively increase its foreign reserves, which did provide it the space to actually intervene and sell foreign exchange to defend the Lira in 2020. For the depreciation, we see Georgia running a structural current account deficit and generally being a user of foreign exchange, which is why we see pressures on the exchange rate on a forward-looking basis.
And while other countries have eased their monetary policy to increase economic output, Georgian economy has more serious challenges that are linked to currency fluctuations and inflationary expectations. So that is why we have tightened the monetary policy. What are your expectations about it? Should we expect additional tightening in this area?
Again, I think the central bank takes into account not just the needs of in growth. It has to look at inflation because it has an inflation targeting mandate. And one of the things for Georgia, one of the features is that the pass-through of depreciation and imported inflation tends to have quite an impact on inflation. So I think that that is something that the central bank tends to look at. But then there's also the factor of dollarization. And the central bank wants to prevent a fairly rapid increase in the debt service for those loans, for example, that are denominated in foreign exchange. And whenever you have a depreciation, that debt service can rise. So I think that this sort of it constrains monetary policy a little bit in Georgia, because the central bank not only has to take into account growth considerations, it also has to take into account what the effect depreciation has on dollarization, not just on inflation, and what it does to the debt service, and ultimately how that feeds back into growth and into price stability.
Mm-hmm. In Georgia, currently, we see an increased uncertainty about vaccine rollout. So in spite of national targets to inoculate 60% of our population, the first doses of vaccines have not yet arrived in the country. And Georgian government is talking about some kind of miscommunication with international COVAX platform. In your opinion, what effect can it have on economic growth prospects of Georgia, the vaccination rate, and what effect can it have on tourism inflows in country?
Mm-hmm. So we think that in general, countries that can roll out vaccines sooner successfully are going to be able to restart their domestic economies at a faster pace while keeping infections in check. Now, small delays are less likely to be a concern. What we identify as a bigger impediment right now to vaccine rollouts is just the supply constraints globally and matched with a very strong demand across the world for vaccines and vaccine hesitancy in some economies, including in Georgia, where people are not necessarily sure they would want to take the vaccine. Now, the ability of most governments, not just in Georgia, to deliver on their fairly ambitious targets of having large percentages of their populations inoculated seem to be challenged at this point of time with the considerations that we just discussed. But then again, we we kind of have been seeing that emerging markets in particular have had a slower rollout of vaccines. Now, in Georgia's case, with the vaccines that it has contracted through COVAX, and just looking at the distribution schedule that COVAX has published, only about 3% of the population will be vaccinated in the first half of 2021 as things currently stand. So from the tourism point of view, and even from the domestic economy point of view, it might be harder for governments, including in Georgia, to restart and reopen their economies on a more sustainable footing while large portions of their population remain unvaccinated.
Mm-hmm. And to follow up on the tourism sector, the mobility and tourism were the main victims of the pandemic, and Georgia saw tremendous fall in tourism revenues. In your opinion, do you see tourism dependency as a potential risk for economies? Would it be reasonable to think about more diversification in economic sectors?
I think in general, we do see the concentration in any particular sector or industry, whether it is tourism in some countries such as hydrocarbons, or in any one particular area as a ratings negative, generally, because it sort of puts the economy at risk when an episode like this happens. So yeah, I think in general, our opinion is that diversification and multiple revenue sources are a good thing, and the lack of diversification and concentration, it tends to expose economies to more vulnerabilities in adverse times. Yeah, I think there have been efforts from Georgian policymakers to diversify the economy over time, but some of these areas will also likely be affected. For instance, in our outlook, we think that direct investment inflows are going to be impacted, which in turn impacts some of the investment projects that the government was hoping to get in place, and the future of Georgia as a regional hub. And those aspirations might have to be tempered a little bit given the new realities.
Mm-hmm. And Georgian government plans to refinance the $500 million bonds that were issued in 2011. Do you have any communication with Georgian government about this issue? The refinancing is planned to be in April of 2021.
Well, I think the stated objective of the government is to refinance this bond. They were initially planning to pay it down. And honestly, they have the buffers at this point of time to select either of those options. So yes, I think that the conditions are present in the market for them to approach the markets, or if they choose, they can also pay it down. It is a policy decision that they are considering themselves, but I believe that they've stated that they intend to refinance the bond through fresh issuance, or rather through issuance.
My next question will be about political situation in country. So as S&P has mentioned, there is increased uncertainty on the political side in Georgia. What effect can it have on Georgia's investment climate and economic growth?
Yeah, I think that's a very good question, Shota. I want to flag that firstly, political instability on its own does not affect credit ratings. From our point of view, what matters is the impact of political instability on policy, right? Of course, when you have frequent crises in the political sphere, they do tend to take time and attention away from reforms. And in our report for Georgia, we do flag that the political volatility that we've seen in some form or the other for the past couple of years now can slow reform momentum. It can also hurt, the perception with foreign investors. It is a risk for growth. It is a risk for financing. Investors tend to seek out stability and predictability for their investments, and they like to see the rule of law being implemented. So far, I have to say that we don't really see very big reversals of previously implemented reforms, which have actually helped Georgia to gain its reputation as a good place to do business in the region. But we are increasingly concerned that there is a tendency towards centralization of power. And we wonder in what direction that will go. But like I said, we haven't sort of really seen that translate very significantly into policy action or inaction so far.
Mm-hmm. So, as Georgian government has publicly announced, their aim is to increase country's sovereign rating to investment grade level. Since it took almost 8 years to increase the ranking from BB minus to BB, how many years of reforms and growth can it take to further increase credit score? And what are the main indicators you look at? Is it the GDP per capita levels, institutional stability, economic growth, or balance of payments?
Again, good question, Shota. I think the first thing to flag really is that at this point of time, we have a negative outlook on Georgia's ratings, on Georgia's sovereign ratings. So at this point, we see a higher probability of a downgrade rather than an upgrade, right? And to your question on the time it takes to get to investment grade, now different sovereigns take different amounts of time to reach investment grade. There are no sort of fixed time frames of when, if at all, a sovereign rating would get there. Now, from the ratings point of view, some of the important things that we look at, we review the role of policy in delivering solid macroeconomic outcomes, like we just discussed in your previous question. We look at that very closely. And the policy of determining good macroeconomic outcomes also includes a prudent fiscal policy. We look at the economy's income levels, we look at growth prospects. We also do, so these two are the pillars and very important parts of the rating, the structure of the economy, its growth prospects, and policy effectiveness. But we also do consider the balance of payments. We look at the financing of the current account deficit, if the country is running one, its prospects of paying down its external debt, reserve adequacy. We look at the success of monetary policy in achieving low levels of inflation. We look at the government's debt profile, so including the stock of debt and other characteristics of its debt. Those are the areas that we tend to look at. From Georgia's point of view, the move towards investment grade, hypothetically, for that to happen, we would have to see a fairly substantial shift in Georgia's income levels. And this is likely to require a shift in its growth model away from the currently relatively lower value add to a higher value addition. And we would also have to see some of the external vulnerabilities that we identify. We would like to see those diminished. So, for example, we would like to see a reduction, a sustainable reduction in the current account deficit, a reduction in the external financing needs the economy has, and coupled with a rise in its export earnings and higher external buffers through foreign exchange reserves.
We are BMG. Follow and subscribe for business and economics news.